Hi, everybody, and welcome back to our last and fourth video on Chapter 20. When we left off, we were looking at the master budget process for a merchandiser. And unlike a manufacturing company, this merchandiser has to prepare its merchandise purchases budget rather than a production budget. And that's a whole lot easier, to be honest. And here they're going to talk about sales and what they sell, their purchases. And those purchases are purchases of finished goods already completed. They're just bringing them into the store like maybe IKEA would, and they sell it to us as a finished product. They clearly have capital expenditures that they need for that purpose and SG&A expenses, and they need separate budgets for that. But it all rolls into a cash budget for them, and that results in budgeted financial statements eventually also. So if I take a look now at preparing that purchasing budget, it's similar. The equation structure is really almost identical. They have units that they need to purchase, and they start out with the budgeted sales that they need to um, to have on hand. And then they also have some ending inventory. So they add those two together, they get their available inventory, and then back out the beginning inventory of purchases they've made previously. So pretty easy. And here's Hockey Den. I'm going to guess that's a retailer of the Toronto sticks. And here they're budgeting their sales and the desired inventory that they want to have. They're going to talk about next period's budgeted sales. So they're bringing this over to here and this over to here. And the ratio of inventory to future sales, they want to be 90%. And so their desired ending inventory balance is going to be 720 units. That means they're going to have required units of 1,720 units, back out their beginning inventory units, and that leaves them units to purchase. Very similar to what we did for the manufacturing materials budget. And then we just cost it based on their cost per unit from hockey sticks, and that tells us how much they're going to purchase in dollars. Pretty straightforward, I think. And now we're going to look at this cash payments for that. They're not going to do anything different than hockey sticks did. Here's their purchases, but in the current period, they're going to get 60% of that. But in prior periods, they're going to pay hockey sticks based on future purchases. So of that 42,600, if I multiply that little beauty times 0.6, I get 25,560, and that's where that comes from. They're not paying this 42,600 until November. That's what that says, of course. And so that means we're going to make cash payments as follows. But we always subtract that beginning inventory to determine the budgeted number of the units to be purchased, because we don't need to purchase that beginning inventory again. Pretty straightforward, right? Okay, that ends chapter 20. And when we come back, we will go to chapter 21. Until that time, bye for now.